Thanks for downloading Pave the Way Podcast. On this show, your host, Greg Helbeck, interviews the top minds in real estate, business, and personal development to help you crack the code so you can grow your business and, more importantly, grow your life. Get ready for another game-changing episode. If you want to learn how to master your day and become a productivity monster, download Greg's free guide on daily personal productivity for free at www.pavetheday.com. That's Pave the Day, spelled D-A-Y.com. Now it's time for today's episode. Enjoy.
What's going on, everyone? Welcome back to another episode of Pave the Way Podcast. I'm here with Matt Ricciardella out of Las Vegas from Crystal View Capital. And we're going to talk today about Matt's journey as an entrepreneur and what he has done to build a very successful commercial real estate business in the self-storage and in the mobile home park sector, which are two sectors I'm actually very interested in learning more about. So, Matt, I appreciate you coming on today to be a guest.
Thanks for having me, Greg. I'm glad to be here today.
Awesome. Well, let's get right into it. I've been looking forward to this for a couple of weeks now. So, can you give the listeners a little bit about, your journey as an entrepreneur, maybe what you were doing before you decided to take the leap?
Yeah, I'd be happy to. As we chatted about prior to the podcast, I'm from upstate New York originally, and actually the Kingston area in the Hudson Valley. Moved to Southern California at 20 years old to start my journey as an entrepreneur. I became a residential realtor at that time and built my business up through direct prospecting. So what I did at that time was a lot of cold calling, knocking on doors, just kind of rolling up your sleeves and getting, down and dirty and grinding away and doing what you had to do to make it work, and built up some business doing that. And that kind of gave me the entree into what I did next, which was real estate investments. And what it allowed me to do is learn the sales process. So all of our deals, all my deals at that time, I sourced them off market. So I'd go directly to the owners versus dealing with brokers to find deals or participating in auctions. I'd cultivate a relationship with the owner of a property. And I actually got into the flipping business from there. I was flipping single family residents in Southern California.
What area in Southern Cal? Because I do the same thing you're doing right now, which is funny.
Yeah, Long Beach, California, in Orange County, Southern LA County at that time.
Okay.
The way I got started is I was cold calling for a listing as a realtor, and the seller said, "Why don't you buy the property?" And I thought, well, I'm 22 years old. I could barely get a loan for a credit card, let alone buy a property. But that was in the heyday when they were kind of giving loans out like it was candy, and I got pre-approved. Bought a duplex in Long Beach in 2004 and sold it. Bought it for $330,000, sold it 2 years later for $700,000, and then kind of launched my career in the flipping business. So kind of went out there and replicated that process over and over again, found all these deals off market, made improvements to the houses, flipped them. And at that stage, I thought, this is great. I'm making way more money than I ever dreamed of, but I would like to have some perpetual cash flow, recurring income versus having to go out there and to do it myself over and over again. So I thought, well, I think commercial real estate investing would provide that for me, would give me that monthly cash flow. So applied the same concept with the sales, finding these deals off market, finding these owners. We bought multifamily, retail, industrial, office. And what I found time and time again, there was two property types that threw off more cash flow than all the rest. And I liked how I could buy them, and I liked how I could improve their operations. Those two property types were self-storage and manufactured housing communities. So I kind of made that my niche focus and went throughout the country and picked up the phone and built these relationships and syndicated several deals, improved operations, did well, sold some, kept some. And then I kind of reached another crossroads where I said, I think I'm on to something, but this isn't scalable because I'm relying on my own capital, which is finite. So if I want to scale, I'm going to have to tap into other capital sources. So I launched a fund And that was back in 2014. And what that means is I went out to mostly high net worth individuals and I raised equity capital from them. And I pooled that equity capital, went out there. It was $10 million that I raised and started applying the strategy. But I was just a general partner now. And I had these limited partners. And that first fund went extremely well. And just recently, we sold our last asset. That fund has gone full cycle, and the returns were 47%. So it was
Holy cow.
very strong returns. And when we launched our second fund in 2018, we were oversubscribed. We set out to raise 35 million, and we actually raised 58 million. Same strategy. Built up a team to manage these properties. Obviously, I'm not doing it myself anymore, but we're at this point looking at roughly a 39% return on that second fund. And as of late, just launched our third fund, Crystal View Capital Fund 3, which is a $95 million equity offering. And we've already raised 70 million since the launch, which was November 2020. And that's the same strategy. So here we are today, and excited about what the future holds.
That's amazing, man. That's an incredible journey. You sound like me, because I'm 26. I started when I was 20, and I am fixing flipping houses. Sometimes I actually just did a Southern California deal today. I used to live in San Diego. I just moved back here.
Okay.
So literally almost doing the same thing you were doing. I just closed on a small commercial property, but shows about you, not about me. So I have some follow-up questions for you. So a lot of my listeners right now, they are in a situation where they're making money in single family home flipping. They might be making, multiple 6, if not 7 figures of income. I have listeners who do that. But like you said, it's a deal by deal life. Like, you got to hunt that next fix and flip down. You got to hunt that next assignment deal down in order to make money again. So how did you kind of break away from that, the crack of flipping houses? Because it's very hard for people to leave, a 7-figure income potentially to then go jump into commercial, which is similar but also different. How did you really strategize so you didn't just totally rip up what you built and jump into uncharted waters? So, like, what did that process look like when you made that shift?
Well, I guess it wasn't one thing. It was more or less a mindset shift. At that stage, I realized, if I really want to make big money, which that's what I wanted to do, I thought I could still flip. It's just I'm going to flip another asset class. My thought process was, let me buy these commercial properties. I'm going to get cash flow, and I could tweak their operations. And basically, I think what attracted me is I could internally basically control my own destiny, because the value of the property wasn't dependent on the market like it is in residential.
Yeah.
Where this Mary Smith across the street just sold for $325, therefore I'm worth $330 type of concept. Here, you could control it. And the way you do that is you buy a property, you identify where it's run inefficiently, you solve those inefficiencies, you increase cash flow. Now there's a cap rate applied to that new cash flow, and you have now, basically determined the value of the property internally.
Yeah.
Being reliant on market forces. So that whole idea was very alluring to me. And I thought, if I could make these tweaks quickly, I could still flip. I could still, do well and make these quick pops, and then I'll get the cash flow too, and I'll hold my best investments. So that whole idea is kind of what made me make the leap from residential into commercial. And, I'm very glad I made it.
Yeah, no, that's absolutely. It sounds incredible. So you mentioned the 2 asset classes you like best. You've gotten involved in other ones. So I want to talk a little bit about the ones you didn't like and why you didn't like them. And then we'll focus on the ones that you like and why you like them. So what about the industrial and the retail? Did you do office too, or no office?
Yeah, we had an office.
You had office. So what about those 3 property, subsect or subtypes did you not like? Because I actually own a retail spot right now, a part retail, and it sucks, to be honest with you. It's terrible. And I hate it. So,
well, yeah. I guess there's several things. I guess it's preference for one. I noticed that in retail, let's compare it to self-storage as an example. In retail, a tenant moves out. Okay, now you got to release the space. Now you got to offer it for rent. You got to pay a broker sometimes tens of thousands, if not hundreds of thousands of dollars Not only that, a tenant is going to come in and say, all right, well, your last tenant was a hair salon. I'm not a hair salon. I'm a pizza shop. I want a gas, stove over here. I want to put a deep fryer over there. I want to have, a soda station over here. So now you got to do these tenant improvements to repurpose that space for your new tenant. That's going to cost you tens of thousands, if not hundreds of thousands of dollars. So it was a lot more cash intensive. It required more CapEx versus a storage unit. Your tenant moves out, you go over there with a broom, you sweep the unit out, you release it, and you got your rent coming back in, and it's immediate. On the retail side, that process could take months, if not years. Yeah. So I guess those qualities kind of attracted me more so to storage and manufactured housing compared to retail, and retail's just one example. And there's several other characteristics which attracts me to these two asset classes as well. And that doesn't mean you can't make a lot of money in retail or office or industrial, because a lot of people do. It's just they kind of fit my personality, I think, because they're easier to manage, they're simple, they're understandable, and you have to grind it out. And that's kind of what I've always been good at, and that's what people don't like to do. So
yeah, no, that makes sense. So now you just brought it up. So the two asset, well, I'm not familiar with mobile home parks. I am a tenant in a self-storage building because I have crap in San Diego that is still there. So I can tell you one thing. Quick story. So I was moving my stuff. I was going to ship it in a pod, but the pod thing didn't work out. I found these storage places are all over the place in this one area of San Diego. I went to one storage facility, and it just showed, the reason I'm saying this is because it shows how, if you have a good operation, how much of a difference it makes. The people running it probably got out of jail. They had a vicious dog running around there, and it was just managed like crap. And I turned right around there and I said, we're going across the street. I went across the street, professional, turnkey, easy, no resistance, simple, streamlined process. And they have my business. And it just shows like, wow, like if you have a well-ran self-storage facility, how much of a difference it makes. So what about, besides the obvious, that the tenant turnover, do you like about the self-storage mobile home park niche? Because you mentioned the cash flow was a lot higher. So what was at least in mobile home parks, like, because I look at mobile home parks almost like apartments, but they're not apartments, they're on little blocks. So like what about that mobile home park makes the cash flow better? I just don't know that space that well.
Yeah, so we made a comparison to storage and retail a moment ago. Let's make a comparison to manufactured housing or mobile home communities to apartments.
Yeah.
Right now. So if you think about an apartment, we've all lived in an apartment unit. I have. I'm not sure if you have. But
I have many times. Yes.
So, when you own an apartment complex, your tenant moves out, right? So sometimes they leave it immaculate, but more times than not, they don't. So you have to recarpet the space. You have to go in there and you have to put a new vanity in, new toilet, paint, all of that. Now compare it to a mobile home park. In a mobile home park, 90% of our tenants, they own their own home. So really there is no moving out, because to move from an apartment A to apartment B across the street, you just pack your stuff up and move across the street. When you own your home and it costs you $6,000 to $8,000 to move the home, typically those tenants do not leave. They stay there long term. So you're not going to have that turnover. And then you're not going to have the repair and maintenance on top of it. I mentioned the sinks, the toilets, the roofs. If they own their own home, all you're renting is that lot. All you're maintaining is the infrastructure, the community, the roads, the clubhouse. You're keeping it paved. You're keeping it, in the winter, you're plowing the snow. In the summer, you're mowing the grass. So it's the repair and maintenance is a lot lower. The overhead is a lot lower. And all that translates into is higher free cash flow.
That makes sense. That makes a lot of sense, because the apartments, I have noticed, like I have tenants now, one of them, they're townhouses, and then I have another small apartment complex, but there is a lot more drama I've noticed with that. And it's like one tenant's pissed at the other tenant because they're living right on top of each other. The stinky shoes are in the hallway. But with the manufactured homes, like it makes sense. Like they all own their own property for the most part. So it just keeps everything more civilized. What do you guys do when you have a lead come in, for example, and there's a bunch of park-owned homes. Are you seller? What are you doing with those homes? Because I'm sure the last thing you want to do is own the home and then have to deal with a broken, stupid vanity in a mobile home, or manufactured home. So what are you guys doing with that when you acquire an asset with a lot of park-owned properties?
Yeah, so that's a good question. That's typically the only time we'll have park-owned homes is by virtue of the acquisition, because the prior owner had it set up in that way. What we look to do is sell them to the residents. So we'll offer them a great deal to sell them. And it's a win-win deal, by the way, when we sell them the home, because now they're going to have an asset, which for the most part could be their most valuable asset. They're always own this home. And what we've done is we've eliminated and alleviated ourselves from the repair and maintenance costs to maintain these homes. So we look to immediately sell the home to the tenants that are within them. And usually they want to do a deal because it's beneficial for them.
Yeah, they own something. Are you selling on terms, or are they generally just going to do a lump sum of cash at a discount just so you get it off your books?
And if they have the cash, obviously that's ideal. If they don't, we do a rent-to-own type program until they can pay it off.
Yeah, no, that makes sense. So that really kind of, I think a lot of people listening here, a lot of my listeners do have rentals, or single family rentals, townhouses, apartments, and they're great. But I have noticed, I mean, you know this way better than I do, but getting a bad tenant, especially when you own that there's nothing worse than dealing with bad tenants. They're just, especially when you inherit them, it's hell on earth. I'm dealing with it right now, especially in New York. I mean, I got this lawyer I just hired to get these knuckleheads out of my property, and it's tough.
I'll tell you this, Greg, I understand your pain. We have tens and thousands of them. So we're dealing with them on a daily basis. But that's the beauty of systems and efficiencies. It makes that process, I'm not going to say it's perfect. You're going to have your bumps and bruises along the way, but at the end of the day, you find a way to make it efficient and ultimately profitable for yourself and your partners. And we have stuff in New York too. Oh,
you do? I was going to ask that. Is there some states that you stay out of because of some of the landlord-tenant laws?
Well, quite frankly, sometimes I wish I did stay out of New York, but I didn't. So it's late now. But we do have two nice properties. One's in Rochester.
Okay.
330 site mobile home community. And we have another 220 site community outside of Buffalo. And
okay.
Both full for the most part, very quality communities. But you got to deal with rent control. You've got to deal with a very tenant friendly state. A lot of regulation, a lot of red tape. So you just have to be aware of the laws before making an investment in a state like New York.
Absolutely. Are you buying out in California as well, or is there some states like Oregon, Washington, some of those West Coast states get a little tough? New Jersey, some of those other states.
We've owned in all of those states. They are tougher, but we're really opportunistic. So when we look at a deal, if it really works and we're really confident about our ability to execute upon the business plan to create value, I'm not going to pass on it just because you say, it's in New York, or it's in California, because honestly, those states, they do trade at lower cap rates. So
absolutely,
bear that in mind too. But you gotta deal with it in between the time you buy it and the time you sell it. So there's more management intensity in those states for sure. There's more compliance that you need to invest in those type of states. But we wouldn't pass just because of a state that a property is located in due to regulation.
Yeah, no, that makes sense, especially too that I've always found the demand to get a tenant in New York is not that hard. I mean, there's a lot of people living around here by the city, and the housing prices they keep going up. So now the last part of the show I have, this has been awesome, by the way. I could talk to you for hours, but I want to respect your time. You mentioned something in the beginning of the podcast. You're buying properties that you can value add, AKA increase the net operating income and make the property more profitable. So it's a 40-minute show. So what are some simple things that you do, or at least that you look for when you're analyzing a potential deal? So when you buy the property, you can immediately add some value and get yourself in a better position from maybe the first 90 days to 6 months.
Yeah, it's a great question. I mean, there's several things. One, we look at the rents. We do market surveys and analysis within that micro market, and we determine what is really the market rent. And a lot of these sellers that we buy from, some of them are slightly below market. Others are grossly below market. So what we've determined is when we buy these properties, we could make improvements to the properties, such as roads in a manufactured housing community, clubhouses, solving some deferred maintenance issues, and then we could bring those rents up to a market level, increase NOI, as you mentioned, and now all of a sudden the property is a lot more profitable and valuable because it's going to trade at a higher valuation because of the increase in NOI. On the storage side, it's a lot of times there's vacancy issues, and that doesn't mean necessarily there's anything wrong with the property. A lot of the owners that we buy from may not have an online marketing presence. So coming in there and putting in a website, having Google AdWords, and having basically some platforms that's going to bring tenants to our property is going to allow us to increase occupancy rather quickly under our ownership. And that increase in occupancy is going to drop to the bottom line. And now it's going to translate into higher cash flows and a higher valuation.
That makes a lot of sense. No, especially with this is what I've noticed. You know this way more than I do once again, but with the storage and with the mobile home park, it's just so much easier to find tenants. And not only find tenants, but you just said get a crystal clear view on what the market rent should be, so you can add some value by raising that rent. And it's interesting. I'm sure you obviously have been doing a lot of direct to owner stuff. Some of these owners, they're totally cool with taking 60 cents on the dollar rent, and they don't want to deal with it. They just don't want to have to go and encounter resistance with their tenants because they're maybe in their getting up there in age. And it's these opportunities are just right there in front of you to solve. It's not like we're doing brain surgery here. And it's amazing what you can do when you just keep it simple. And like you said, follow a great business plan. With the self-storage question on that, how long do you see the average tenant stay? Because sometimes people are going to go into storage for 2 months because they're moving across the state or whatever. So what is a pretty consistent length of tenancy with a self-storage unit?
There's a national average actually on that statistic.
Yeah.
It's 9 months. The average tenant stays for 9 months. So, you're going to get tenants that move out in 3 months. It's uncommon, to be honest. I think, honestly, in our portfolio, it's probably longer than that. I never ran that stat, but I would say it's over a year. A lot of times, when we buy these properties, they have legacy tenants that have been there for 10, 20, 30 years. And they just don't move, both on the self-storage and the mobile home communities. So they are stickier tenants for sure, because the process to move your stuff from one storage unit to another one down the street is quite burdensome and costly. And if the rent's the same, why would you do it? And then on the mobile home park side, it's quite burdensome and it's very expensive to actually pick up your home, have a transport company get it on wheels, move it down the street, rehook up the utilities, reskirt it, all of that. That process could cost you $6,000, $8,000. So you've got a very sticky resident base. So, we pride ourselves with taking care of our tenants and our residents. And as a result of that, we've got this cash flow that comes in and month out.
That's amazing. And that's why a lot of these people get into real estate, including myself, for that. They call that the MRR, monthly recurring revenue. And in the fix and flip land or the wholesale land, you can make big paychecks, but you gotta fight for that next deal, man. It's like we're the brokerage business. It's the same thing. You make that commission and you gotta move on to the next one. It's a very transactional mindset, which doesn't really play well for the long game. I've noticed, people make,
What I would say for your listeners is why not have the best of both worlds? I mean, I wouldn't necessarily advocate if you're making 7 figures on flipping, like you had mentioned, some of your listeners are, no reason to shut down shop, but why not introduce this idea of this reoccurring income on top of what you're doing with your flips, and now you have the best of both worlds.
Absolutely. You have your cake and eat it too.
Yeah.
You have the short game and the long game,
Yeah.
Awesome. Final question here before we share with the listeners how they can reach out to you is, you mentioned earlier in the beginning, I was trying to just take a lot of the stuff you said in the intro. You're buying assets, you're holding them for, 3 to 5 to 7 to 10 years, and then you're disposing the assets and selling them. what makes you, besides the obvious, the NOI, the market's hot, what do you kind of do when you're prepared to sell a property? Like, what makes your group, what makes you guys want to sell that property after that specific timeline? Because a lot of people I know also, they'll like burr these things and they'll like refinance their basis and they'll just like keep it. But then some people love to sell the property. So my question really for you is, what makes you want to sell them?
Yeah, I think what you're asking, just to rephrase the question, how do you know when the best
time? I should have asked it that way. Yeah.
So I wish I had a simple answer for you, Greg. That to really know when the best time to sell, you'd have to have the crystal ball with the future hold. I mean, ideally you'd sell right at a market peak.
Yeah, like now.
Unfortunately, none of us have that wall. So what we do is we underwrite our deals to a certain internal rate of return. And we underwrite them based upon a 3, 5, 7, 10-year hold. And then we reevaluate those 3, 5, 7, 10 years. Quite frankly, we reevaluate every quarter, but we really do a reevaluation during those benchmarks. And if we've hit our return profiles, we consider selling. And if we could hit, basically the market would allow us to hit those return profiles, we would take advantage of it. But I will say this, right now in this market, it's so heated that we're getting unsolicited offers for way above what we pro forma these deals at. So sometimes I'll give you one example of a deal we did in our second fund. And I think this would help answer your question. We bought a mobile home community in Kentucky. It was in Louisville, Kentucky, and we bought it late last year. And we acquired it for $7 million. We made some improvements to it, made the property more valuable following the strategies that we mentioned here. And we received an unsolicited offer 8 months into our ownership for $15 million.
Oh my gosh.
So, yeah, that was my thoughts exactly when I got it.
I'm like, okay.
And, although we earmarked this asset as a long-term hold, we basically were getting more for it in 8 months than we projected to get, 8 to 10 years from now.
Yeah.
Particular property. And as much as we wanted to continue adding value to it, and as much as we liked the property, and as much as we could incrementally increase revenues, it really was in the best interest of our investors to go ahead and make this deal and sell this asset. So we did it. Obviously, nobody complained, but that was about a 350% return on that investment, an IRR, and it was about 4 times our money in 8 months. So just an exceptional deal. But these things happen, so it's hard to gauge the perfect time to sell. But by and large, if you could hit your performance, it's great to sell and book that return. And on other assets, you kind of have seller's remorse because you could have got more in the future. So it's, again, best of both worlds. It's good to sell some in case you have a crash or adjustment. It's good to keep some so you have that reoccurring revenue.
Yep. No, that's awesome, man. This has been super fun. I'm glad we were able to get you on here and I could talk this stuff. This is like, this doesn't feel like work to me. It's all fun talking about deals. So
it's gotta be fun. Otherwise you're not going to show up tomorrow.
That's true. Exactly. If you're not having fun, it's going to feel like a job, So if people want to learn more about you and your company, reach out to you guys, what is the best way for them to reach you? And then the best way for them to reach your company? Maybe they're interested in maybe participate in your fund.
Yeah, if you wanted to reach out to us, you could email our group at invest@crystalviewcapital.com. And to learn a bit more about the company, visit our website at www.crystalviewcapital.com.
Awesome. Well, I'll make sure that Anna puts this in the show notes and we'll have that all linked up there. Matt, it's been awesome to have you on the show as a guest. I learned a lot myself today, and I hope you have a great rest of your day, man. Thanks so much for coming on.
Absolutely. My pleasure, Greg. Thanks for having me.
Thanks for listening to another episode of Pave the Way Podcast. We hope you got value from today's episode. Make sure you download Greg's free guide on daily personal productivity for free at www.pavetheday.com. That's Pave the Day spelled DAY.com. If you have any questions or want to reach out, head over to www.pavethewaypodcast.com. We'll see you on the next episode.